I just admitted everybody. Welcome, everybody. We are just going to give it a minute to let everybody join.
We're going to try to keep this as interactive as possible and answer all your questions. So feel free to take yourselves off mute, put your camera on.
Give it another 30 seconds or so. Hope everybody's having a great Friday so far. Beautiful weather. All right. Should we get started, Todd?
Yeah, let's go ahead. I think we've
Okay. All right. Welcome, everybody, to the Wells Fargo 2025 financial calendar for you all. We're going to be focusing on tax planning strategies today, and really specifically going over some actions to take that can save you some money on taxes this year and even going forward. As Todd just mentioned, we want to hear from you, have some dialogue, and I'm in the middle finishing up my taxes. Maybe you have a question on your end. There's no dumb questions. You can put it in the chat. Our contact link will also be in the chat. And if you want to have a more specific dialogue with us, you can set up a time after this call or next week. The Just stick around towards the end. There's going to be a link sent to you with the current financial calendar if you don't already have it. Stick around towards the end. Also, Todd's going to go over some exciting news. We just launched a brand new education series, so we're going to go over that towards the end. All right, let's get started. Again, if you're just joining, you didn't miss anything. We're going to jump right in, and we're going to be going over some tax planning strategies. And just the first thing to be aware of, with it being March 15th specifically, which is come and gone, is when paid time off and FSA benefits do expire. So it's something to mark on your calendar for next year if you don't already have that marked. Also, the HSA and IRA contribution deadline's coming up. If you haven't filed your taxes by April 15th, you can still contribute for last year's HSA and IRA. And Todd's going to put the limits, the maximum contributions in the chat that you can make toward the health savings account and individual retirement accounts. And when I say IRA, that also means Roth IRAs combined with those totals will be. Again, if you have any questions, we'll get to a pause every 10 minutes for questions, but you can put it in the chat and we'll get to it. All right. So let's start off and talk about what do taxes and retirement savings have to do with one another. And so the question is, are you funding your three retirement tax buckets? And so I just want to start with a question for the group. Does anybody know what the three retirement tax buckets are that I'm referring? And you can put in the chat or say yes, or maybe say no, or just list them.
Yeah, feel free to come off mute. You guys have I think you have the ability to unmute yourselves here. If you don't, just let us know.
Right.
I think Deborah's saying no, she's not sure about the three tax buckets. Who else? Doris, Ed, Matthew. I think Ramesh just joined.
So again, does anybody know what the three tax buckets are? All right.
Yeah. I think Matthew
Any correct
dropped it
answer?
in there. So yeah, you're right on, Matthew. Britton will
Okay.
talk about it a little bit more.
Sure. So it is, you're already probably saving to one or two of these, maybe all three. And the first one is the before tax or pre-tax or tax deferred retirement account. Traditional 401ks at Wells Fargo, you have access to that. You're getting a match every year. Or you could also do the Roth 401k at into your 401k. In other words, it's the two differences between those are you're gonna in the first one reduce taxes today. So that's gonna be you're deferring until later to pay the taxes. In other words, if you put in $20,000 into the 401k this year, you're not gonna pay money taxes on the growth or those dollars until you take it out in retirement. The idea is that you'll be in a lower tax bracket in retirement. Nobody has a crystal ball, but if you're earning over your years and you're not, especially towards the last few years heading into retirement, it's it's likely you'll be in a higher bracket than you versus when you're in retirement. The other bucket, the Roth, is you're going to pay taxes on the dollars going in. So it reduces taxes in retirement. Now you're going to pay taxes on the contributions into the Roth, but it goes tax free. And when you take the money out, there's no taxable event at that point in time. So it's a huge benefit into retirement, especially if you have a long time frame between now and into when you plan to retire. The third bucket is I'm going to list it as a brokerage account, but us advisors call it a taxable account. It may be titled like a joint account or a trust account. And this is an important bucket. It's kind of overseen when it comes to retirement, and because you can use it for anything. There's no penalty to take money out. The money that goes into it is you've already paid taxes on those dollars, and you're going to pay taxes as it grows. Like if you get dividends and interest from your securities that are invested. Uh, the real purpose of it is to be able to fund early retirement options, or whether you're in your 50s or even in your 60s, and you can delay things like Social Security and live off of your income from this account. It keeps you in a lower bracket, tax bracket that is, which means if you're on Medicare, you'll be paying less premiums, possibly also opening up opportunities to do Roth conversions. So the third bucket, the brokerage account, really is a great tool for tax planning strategies. We do that with the clients all the time in early retirement. There's a small window to do some of those when you do drop into a lower bracket. So those are the three tax buckets. Todd, anything to add there?
No, we'll just be coming back to those when we talk about some of the strategies. So that's one of the reasons we wanted to just walk through those, because we'll be touching on those as we go through some of these strategies. And as Britton said, that brokerage account or taxable account is very important for some of these strategies. And it's just often overlooked in savings, because so many folks, especially at Wells Fargo, they get a great match, the 401k. That's where most of their savings go, but not we don't want to forget about this taxable bucket either.
Okay, great, thanks. All right, moving on. I'll hand it over to you, Todd.
Yeah. So thanks, Britton. So this is one of the most common questions we get. Wells Fargo offers, and not all companies offer this, so it's great that they give you this option of before tax contributions or after tax or Roth contributions. So this visual, if you look at the top, this just kind of really cuts to, from a tax perspective, why you might want to do one over the other. So if you look at the top image there, it simply shows that if your current marginal tax rate, so the kind of the top of the seesaw there on the left, if it's high now, and then going over to the right, future marginal tax bracket, if you think that's going to be lower in the future, then you may want to go traditional or go pre-tax right now. So put the money into pre-tax and then take it out later when you're in a lower tax bracket. Okay, so that's from just a pure tax standpoint, um, how you want to decide between the two. If you go to the bottom where it's Roth, so if your current marginal tax rate now is low and you think it'll be higher in the future, then you may want to put that money in after tax. A lot of times we say that, especially for people that haven't hit peak earning years yet, and they think their potential for income is greater in the future. Then you put that money, look at putting that money into the Roth right now, and then in the future, if your income is going to be higher when you take it out, then you could take that out tax free. Any questions on that? Anything to add, Britton?
No, I think that's pretty good explanation. We'll come back to these two as well. How to get the money into the Roth outside of the Roth 401k if you're in a higher bracket. All right.
I think next we'll take you through the mechanics of this. So if you're not familiar, if you do want to make some changes to this, you're going to go into the Empower site, which most of you probably know how to access. You're going to go to just a section called Accounts, and then to say Contributions, and then it'll take you to a page like this. Now, the interesting thing about this page, if you notice, and this is often forgotten a lot too, is that there is an option to split your contributions. So we don't know where tax rates are going to be. I mean, in theory, yeah, that visual we just went through, I mean, in a perfect world, we would know those exact numbers, but that may not be the case for many of us. So here you have the option to put it in before tax, Roth, or the third, which is split it. So that's the piece that's often overlooked. If you want to kind of hedge yourself, split it between the two, or some allocation between the two, because really you want to just think about diversifying your taxes in retirement. So all this is looking forward to in retirement. And we see so many people stuck into kind of one of these, pre-tax or taxable accounts, and it doesn't leave them much flexibility. So if you can split it up, that oftentimes is a good strategy for when you hit retirement. And one thing, we're going to put this in here as well, the catch-up contributions and the 401k limits. I'm going to drop that into everyone right now. And there's a new catch-up contribution for those of you that are age 60 to 63. So you could put another 11,250 in above and beyond the 23,500. And this is only for people age 60 or 63. So if you have not done this yet, make sure you increase your contribution now so that you don't fall short in 2025. This extra catch-up contribution has not been talked about much, so it's pretty easily overlooked. And I just dropped that in there. And I think, yeah, Deborah, you asked about what about over 70? Maybe you can expand upon that a little bit. You feel free to come off mute as well. But over 70, you start looking at your required minimum distributions kicking in at 73 and 75. So that may be what you're referring to. Okay. Did that answer your question, Deborah? Perfect. Okay, perfect. Yeah, we'll get into a little bit more also the other opportunities after age 70 as well.
All right. Again, I think a theme here is that there's the balance between before tax and Roth. It's sometimes I lean towards which one's being neglected the most. I run into a lot of clients who have 90% of their money on before tax. And so if there's time to build up the Roth, then yeah, this is a way to do it without going all in. Right. So let's pause for questions.
Yeah, feel free to come off mute. Feel free to jump on video. Yeah, we want to make this as interactive. There's, tax season could be so confusing, and not just tax season, but, kind of taxes throughout the year. Really what we want you to be thinking about here is how to get proactive and take control of your taxes. So again, anything on your mind, drop it in the chat there or come off mute.
Does the match, this is Michael, does the match, is it for both the before tax and the Roth, or is it just the before tax?
Yeah, that's a great question. Yeah, a lot of people are concerned about that. And so they won't put money in the Roth, but there is a match on the Roth, just like the pre-tax. So just think of it as, really it's all going into kind of one bucket. It's just split up tax-wise differently.
So it's just 6% in total.
Right.
Yeah.
Right.
Okay.
Yeah. And the other thing I'll mention, since you brought up the match, Michael, is that they did just change this. If you recall, the 401k match used to be in Wells Fargo stock. So, we would usually, suggest people look at that, because that money is, a lot of times people have, 10, 20% of their 401k in Wells Fargo stock, just because that match built up. Well, this is the first year they matched it. I think it went into the default investment account. But what I would say to do is, if you do have a lot of money built up in Wells Fargo stock within your 401k, I would definitely look at that and, think about diversifying it. I think the comment we always say is, if you wouldn't buy $100,000 worth of Wells Fargo stock today, then, why would you hold it in your account as of today? Because that could get very risky as you get closer to retirement in particular. So just, something to look at and check your 401ks, see what your weighting is in Wells Fargo stock.
Okay,
Anyone else? Yeah, that was a good question.
Great question. We'll pause again at least once or twice more. So if you get something comes to mind, please just hold on to it or put it in the chat.
Yeah. Okay. So we're going to move on to the backdoor Roth. So now we're getting into, some strategies that you can really implement. And the backdoor Roth. So the first thing, and this is very overlooked, often not heard of, or especially not understood. So we're going to take you through kind of some simple steps of how the backdoor Roth works. But just to get a sense of kind of where everyone's at, just knowledge-wise on the backdoor Roth. If you've heard of it, just let me know if you've heard of it or not. So if you've heard of it, just type yes in the chat. If you've not heard of it, just type no in there, just so I have an idea of everyone's knowledge on this, on the backdoor. So we got yes, no, yes.
And this is a little different than just a Roth conversion.
Anyone else? Okay, so for those of you, I guess Michael and Matthew, I'll just direct it to you since you said yes. Sounds like you heard of it. Have either of you done the backdoor Roth? No. So Michael, no. Matthew, no. Okay. Yeah, and that's pretty common. I mean, we see that a lot, that people have heard of it, they kind of wonder about it, they wonder if it's a good thing for them to do. And a lot of it's just because they don't it's not really understood how you do it. So really, the first step, I'll take you through this. The first step is to simply contribute to a traditional IRA. So a lot of people say, well, I make over the limit of 246,000, which is what it is in 2025. And they say, well, I can't contribute to an IRA. Well, yes and no. You can contribute to an IRA, you just don't get the deduction on it. And this is really where the value comes in of converting it to a Roth. So the first step is you contribute that money to the Roth. So $7,000 or $8,000 if you're over age 50. And then step 2 is you simply journal or convert that money from a traditional IRA to your Roth. So if you don't have a Roth IRA open, you need to open that up, and you can go to wherever your brokerage account is at. You just go there. You can sometimes do it online. Usually recommend, work with someone over the phone to do it. Obviously, if you have an advisor, they can do it for you as well. You put that money in, you don't get a tax deduction on it, which is fine. And then that's immediately converted to the Roth. Okay, so when you convert that money to the Roth in step 2, There's no tax consequences if you do that immediately. Now, here's where people kind of get hung up is the step three. And this is kind of a pitfall where it might tell you whether or not you actually should do a Roth conversion or a backdoor Roth or not. So it's something called the pro rata rule. So watch out for the pro rata rule. And that comes into play if you have already a balance in your traditional IRA. It's not as conducive from a tax perspective to turn around and then convert these dollars to a Roth IRA. So I'd say if you have a traditional IRA in place that has a balance in there, especially if it's a large balance, this conversion to a backdoor Roth IRA may not be for you. So that's the first thing you want to look at is really, do I have a balance in my IRA or not? If you don't, great. This is going to work a lot better for you. If you do have a balance, then we want to do a little bit more analysis. So looking at step 4, a lot of people get through step 3 and then they get a little stuck on step 4, which is you have to fill out, it's an IRS form 8606. If you do your taxes, your accountant's going to know how to do this. If you do your taxes on your own, you can just look it up and be able to fill that out. It is important because if you do not fill out this form, then the tax benefit of this could completely fall apart. So this form is very, very important. A lot of times we even see accountants overlooking it. Either they overlooked it or their clients didn't know to pass the information on to them in the appropriate manner. So fill out the tax form 8606. And ideally, you should not be paying any taxes when you do that backdoor Roth. And then simply step 5, you just continue to do this year to year. The idea is you want to accumulate as much in your Roth IRA as you can by doing the backdoor Roth. So if you could do this over multiple years for an extended period of time, it really, really makes a difference. And we have some clients who've been doing this for 15 plus years, and they make well over $246,000, and they have $300,000-$400,000 that built up in the Roth IRAs, which for a lot of people that's kind of unheard of if they haven't taken this strategy to do that. Anything to add, Britton?
No, I mean, if this is new to you, which it sounds like many of you it is, it may look confusing. We do these all the time, and we'll do analysis to see if it's suitable for clients and in their best interest. And yeah, there's kind of an art and science to it. You don't have a crystal ball, but we see what the costs are. And like Todd said, if you do have a large IRA balance, then it's probably not a good strategy. But if you have everything in a 401k and no IRA funds, then this would be a strategy. All right, well, let's jump into still talking about the Roth conversion considerations. Well, we're talking about Roth conversions versus just the backdoor Roth contributions. And so what we're talking about when I say Roth conversion, this means you're converting the traditional IRA or a portion of it and taking money out of it and then putting it into the Roth. It is a taxable event for the dollars that come out because it's coming out of the IRA. But there's a way to get into the Roth again through the brokerage firm that the IRA and the Roth are housed or are custodied. And so the question is, why would you do that? One of the strategies is to reduce required minimum distributions in the future. Aside from having that tax-free growth, if you have most of your money in a pre-tax in that first bucket that we talked about, 401k, and it's built up over the years, if you retire at 60, 65, when you're 73, you have to start taking out roughly 3% of that. And it continues to go up as you get older, and maybe the balance gets higher too. Depends on what the market's doing, of course. But a way to lower that liability is to get the money out earlier in a lower bracket. So it's really a tax play. So if you're in a lower tax bracket, let's say the 12% bracket in early retirement, that might be an opportunity to max out the 12% bracket. In other words, by taking money out of the IRA and putting into the Roth at that point, versus when you may be forecasted to be in the 22% bracket when you're taking money out of the for the RMDs at 73. And so again, there's a need to have money available to pay the taxes because you don't want to withhold it from the IRA and pay out of that portion. So that's where the taxable or the brokerage account comes in to help leverage and use to pay some of those taxes, as well as maybe support some of your lifestyle. So it is a play between those three buckets. They aren't working in isolation. And when it comes to this Roth conversion, and Todd, you've got a story you wanted to share on this as well.
Yeah, this is just an example. This is a Wells Fargo employee. They retired, I think, 6 or 7 years ago now. And where these Roth conversions really work, as Britton said, in early retirement. This couple retired when they were 60. So RMDs weren't going to kick into them for at least 10 years. Social Security probably wouldn't happen until age 70. So you have this window of 10 years where they're in that 12% bracket that Britton talked about. And they had over $1 million accumulated in their 401k. So what was going to happen is when they were in their, say, late 70s, they were going to be bumped into a much higher tax bracket. So what we did is we set up a 10-year strategy for them. So the 10-year strategy was take out $50,000 per year or convert $50,000 per year from their traditional IRA to their Roth IRA, have them pay the 12% taxes on it, knowing that they'd be bumped into the 22% bracket, if not the 24% or even higher later on. So over this period of time, we'll be able to get $500,000 out of that account. In theory, saving them $50,000 in taxes if they would have paid it in the 22% bracket. So again, the key is they're doing this over a series of years. And that 50,000 is very strategic because that 50,000 put them right up to the top of the 12% bracket. So we didn't want them to take out more because then they'd start paying that conversion at the 22% tax rate. So you really there's a strategy to figuring out what is the best number for you to do over an extended period of time. So, you either work with your advisor on that or your CPA might be able to tell you what those numbers are, but we'll do projections for you, to help you figure out where that should be strategically. Anything to add there? Or do you want to just
It's
go
a
right
lot.
to questions on this?
Yeah, if there's any questions, we're going to stop for a Q&A in a second.
Yeah, we typically get a lot of questions. I mean, on these two, we kind of hit on two areas here, the Roth conversion, the backdoor Roth.
Yeah.
So definitely, come off mute if you have questions on this or drop it in the chat. People usually have a lot of questions about these two areas, the backdoor and the Roth conversion.
It seems like, for my own personal situation, there's a lot of uncertainty. You think you're going to work for X amount of years, but I think for folks at Wells Fargo, you always know that's not, it's not for certain. And then, so if there's not certainty around, I'm going to move to this lower tax bracket in my early 60s or something like that, it's kind of take a middle of the road approach where you just don't know yet. You're in the higher tax bracket, you're working, you don't know when that's going to stop. So it's kind of like, do you just kind of stick with mostly with the pre-tax 401k option, and just you have to see if you get a window to kind of convert a Roth strategy like that? Does that make sense?
Yeah, and I think, and we may not have been super clear when we, we're communicating this, but really it works best when you've actually retired. So to do the Roth conversion, typically we really only do these when you're retired because then we know for certain you're in that lower tax bracket, and then we can kind of plan out strategically between when you retire and age 70. And we say age 70 because that's as long as you would push Social Security to.
Right. Right. And then on the back door, I think, I was looking at as you were discussing that, I think you made it pretty clear that like I have money in IRAs from, previous 401ks,
Mhm.
but those probably aren't something that you'd be able to do the back door on.
Right. You probably wouldn't be able to do it because the way it works is let's say, let's just say you convert 20,000.
Mhm.
Well, let's say, um, let's say you have 100,000 in an IRA. I'm just trying to do the math here in my head,
Mhm.
but essentially the majority of that would be taxed when you convert it. So you'd be converting that 20,000 at whatever tax bracket you're at now.
Gotcha.
So it just doesn't make sense. And that's where if you have a zero balance and you contribute in that same year that you do the conversion, you're not taxed when you're not taking a tax deduction on that contribution. So you
Mhm.
can immediately take it out and not be taxed on it. So it's really just a loophole in the tax system. Um, so does that make sense
It does.
about?
It does make sense. So, like, it would make sense if you're able to, if you have the extra cash flow to create a new separate IRA, even if you have these. Do the other ones get in the way?
They
Yeah,
get in the way. So
they
it's
get
an
in the way.
aggregate. When you fill out that 8606 form, it specifically asks if you have a balance in any IRAs.
Okay. All
And
right.
then the 80606 takes you through the calculation of, what percentage of that is taxable.
Gotcha. All right. That's helpful. Thanks.
But
Um,
do you have any, if you don't have any funds going into the Roth 401k, that might be just low hanging fruit to balance and build up that bucket that way.
Right. Right.
And the timing of it as far as getting it in there, it's it's still like after tax dollars getting in. So that's why it's maybe a balance between the two buckets. Um, Markets drop a lot. That's a good time to get into the Roth because it's conventional wisdom says it's coming back.
Mhm.
No
Right.
crystal balls, but yeah, that's kind of it's when you get like 90+% and I'm just throwing out a percentage like in that pre-tax 401k. It's you can see where the risks and the costs really add up down the road with the
Right.
hard taxes.
Good. Thanks.
Mhm. Any other questions? All right. Move into April. All right. So you another theme of this presentation is to provide you some tools to take control of your taxes. And one of the things that you can do very easily, especially this time of the year, is to leverage what the effective tax rate is and what do you do with that. So when you file your taxes, if you have a CPA doing it or you're doing it, somewhere in that return is going to have the effective tax rate calculation or average tax rate calculations very similar. And we're going to show you how to adjust your Wells Fargo withholdings because it comes up all the time of clients of ours at Wells that there's like I'm paying too much taxes consecutively every single year. What do I need to do? And so we're going to talk a little bit about that now. So I hand it over to Todd to go through the mechanics.
That's Britain. So part of what we want to do here is just make you more comfortable when you're, looking at your tax return or talking about taxes. It's just it's such a black box for so many people. We want to educate you a little bit. So this right here is simply a 1040. So this is typically the first page on your tax return. There's a couple items here I want you to focus on. So if you happen to have your returns and you just got them done, take them out, and you can do this here as we go through it. If you look at the 1040 on line 15, it tells you your taxable income. So that's really after your standard deductions and just simply says this is purely what you're taxed on. So in this case, $400,000 is taxable income. And then if you go down to line 24 on your tax return, it says this is your total tax. So there's a lot of lines down there that'll say something about taxes, but it's in bold. It'll say total tax, line 24. This tells you truly how much you owed in taxes, or sorry, owed what you need, what your total tax was for all of your income for the year. And to find your effective tax rate, sometimes the CPA will put it on the return, sometimes they won't. It's all you simply do is take, in this case, 80,000 divided by 400,000. You can check my math. I think that's 20%. So you're in the effective tax rate of 20%. So you kind of know I'm in there. You're looking, in this case, you're looking back at 2023. Once you get your 2024 return, you'll be starting to plan ahead for 2024. So that's how you calculate your effective tax rate. Now, what do you do with it on your pay stub? So that's kind of the next slide I think it's on, Britton. Yeah, so this is just kind of a mock Wells Fargo pay stub. I want to point out a couple of things so that you can start to understand how can you, if you overpaid or underpaid, what do you do about it? So in this case, let's just say year to date, this person was at $75,000 in total income, federal withholding. So the federal withholding was $11,250. Does anyone want to do some math for me? What would be the average rate on that? So 11,250 divided by 75,000.
Anybody?
I think that's going to be 15%. So you could check my math. I think that's 15%. So what that's telling you, so if you go and look at your pay stub right now, say, okay, where am I at year to date in terms of my withholding percentage? So in this case, we're saying it's 15%. We know looking back at the previous tax return that the effective rate was 20%. So there's a gap there of 5%. And what happens, unfortunately, is most people only find out about that gap at tax time, and are wondering where they're going to get that money from, or it's just, they wish they would have been able to set it aside sometime earlier in the year. So what you're going to do at this point is, once you figured out what your effective tax rate is, you compared it to your tax return, you're going to go into Wells Fargo Workday, and this is where you can make your adjustments throughout the year. So if you want to go to the next slide, Britton. So I think most of you are familiar with Workday. There's a section on the left called Pay. Okay. And what most people do is they'll change around the total dependent amount, which is in the middle there. But what they forget about oftentimes is the extra withholding amount. So in this example, it's $950 in extra withholding. So if you know you should be withholding 20% instead of that 15%, you could go in here and kind of manually adjust it and let Wells Fargo take out an extra amount, so that, instead of owing $10,000 extra at the end of the year, you'll take out $950 extra. This is per pay, obviously, but if that's per month, that's roughly $10,000, and that'll make up for any disparity, so you don't owe a big chunk at the end of the year. The other thing I want to mention about that's real important, is often overlooked, is that if you have two working spouses at two different whether at two different companies or not, and they have different income, they're at different income levels. What we'll often see is that the one person will under withhold. So really, if you figure out that, hey, our effective or average rate is 20%, check each person's pay stub separately and say, okay, we're both at 20%. One's not at 15 and one's not at 25, or at 20%. So we essentially know every dollar coming out is going to be taxed appropriately. Again, these are rules of thumb, so we're not saying you're going to get exact, but we want you to be able to have a little bit of control over what you owe at the end of the year. So what I'd encourage you to do is, throughout the year, each quarter, just do this calculation again and check and see, if you're on track or not. Now, again, if your income changes substantially from the previous year, this is, not going to be as effective, but you at least know how to approach this. Any questions on this? I mean, again, we're getting a little more mechanics here.
Yeah, it's also something that, by all means, run it by if you have a tax advisor or CPA. EA is helping you prepare your taxes. They have the final say in anything tax related. We do this for clients periodically throughout the year, particularly around this time or in the fourth quarter. One of the events that may throw you off is bonus time. So you get the new cash bonus that comes in, maybe restricted shares, and that may throw off your taxes a bit. So keep that in mind. Another reason to run it by your accountant or your advisor.
This is Deborah. Can I ask a question?
Sure.
Can you go back a screen for a second, please?
Sure, Deborah.
Okay, I ended up having to pay more federal tax than I thought I would because I am over 70 and I am getting my Social Security plus my Wells Fargo.
Hmm.
So, I don't have any dependents and what have you. How did they figure out how much extra you should do in order not to pay federal taxes next year? I mean, what calculations would I need to do?
Yeah. So did you just start your Social Security?
No,
Okay. So you have 2023 or 2024 because you're probably just getting that done, probably looking at 2024 for you.
correct.
Does that income look pretty similar to 2025?
It's actually going to be higher.
It's going to be higher. Okay. So the first thing you really have to look at is if you actually go back another screen, Britton, to the tax return, because I think that's really where we want to start. This is a great question. And again, I mean, looking at tax returns can obviously often be confusing. So if you look, this is the 1040, and on line 15, it tells you this was your taxable income from last year. So if you have your tax return available, I'd say, pick it up and take a look at this line. Line 15 is really important. And then the total tax, line 24. Okay. So if you look, this is looking backwards, what you paid last year. And in this case, you're going to say, okay, 80,000 divided by 400,000 would be 20%. Okay.
Mhm.
And then you're going to look over at your pay stub and say, okay, am I really on track to pay that amount or not? If you want to go to the next screen again, Britton.
Hmm.
I guess first, Deborah, does that make sense kind of where to go on your tax return to look at what your average rate was for every dollar?
Yes.
Okay, great. So here you're going to go and say, okay, what's being, year to date, if you look at your pay stub year to date, see where you're at. So you're going to look at your total income for the year, in this case, 75,000. Does this look pretty familiar, like what your pay stub would look like?
Yes.
Yeah, okay. And then there's going to be a federal withholding line, and that's going to be, look at the year-to-date number, 11,250, and divide that by your total income. And in this case, this 11,000 divided by 75,000 is going to be 15%. So we know if this was you, you'd be short by 5%. Okay?
Okay.
Because your average was 20%. I think what's happening to you is that you have the Social Security. That's your only other source of income, right? Is there a pension or anything?
No, that's it.
Okay. So a couple things that could be happening. Do you have any taxes being withheld from your Social Security?
No, I didn't know that I needed to do that. First, I
Yeah.
heard of it was last year, and I thought, what?
Yeah. So you can. And this is a great question. We get this a lot. Um, um, but yeah, so you can withhold from your Social Security. So if you know your average, rate is going to be 20%, then talk to Social Security and say, look, I want this withheld. The other option is, you withhold it from your pay stub indirectly, but that gets a little bit more confusing. So you could call them, and that's probably where you continue to see yourself owing money, is because of the Social Security.
So I need to retire then.
Well, it depends. I can't say that for sure, but I could, you'd have to look at obviously a lot, to see what makes the most sense for you. But from a tax perspective, does that help answer your question of where that shortfall might be coming from and how to solve that for this year, at least for 2025?
Yes.
Okay, great. Anything else on that, Deborah, or anyone else?
Not on my end.
Okay, great. Thanks for the question. Really good question. Really, really common, and we see that happening a lot with Social Security, especially if you're still working.
All right.
Okay, so we had another question from Rose.
Okay.
I always get a tax refund. I filed jointly with my husband and a 15-year-old set of twins. Okay. Um, yeah. So in this case, no. So you're saying you always get a tax refund. So yeah, there's probably no reason for you to raise your withholding if you're getting a refund. If you owed money, that's where we're really talking about. If you don't want to have to come out of pocket a big amount of tax time, then you probably want to look at raising that withholding. Now, in your case, and this, I mean, this may not be exactly what you want to do, but I think you bring up a good point. Some people don't like getting money back at tax time because they'd rather hold it in their pockets and not have the government hold on to it. So if that's the case, then sort of the opposite holds. You would reduce the withholding that comes out of your paycheck. Does that answer your question, Rose? Is that?
Yes, thank you so much. Like I said in my question, I always get a refund, but what you just mentioned about maybe try to not get as much as refund as I've been getting for all these years, I
Mhm.
can reduce the withholding, right? I just have to
Right.
put an X amount, or how does that work?
That is a little trickier because then you're dealing primarily with the dependents, because my guess is you don't have any extra withholding coming out on that box. If we just go back to that Britain for a minute, just so
Oh, sorry.
to the extra withholding. So first thing I would check, Rose, is does this look familiar to you, the workday and the pay section?
Yes.
So just make sure you don't have any extra withholding on that line. My guess is you don't. So what you'd have to do is you want to look at how many dependents you have listed. And if you wanted a little bit more back, you would reduce that number of dependents. So it sounds like there's 4 of you. So you probably have 4 dependents listed there, or 2.
I put 2, only the twins.
Okay.
Because like I said, I filed jointly with my husband, and I think he does the same. He put that he files jointly and only the twins as a dependent.
Okay. So one, double check his, and then I would say also, kind of do that exercise where you compare your pay stubs to see if somebody's holding a higher percentage. Did that make sense how we did that, by looking at the pay stub just to see like what percentage you're withholding, and then look at your husband's pay stub? Is he at Wells Fargo too, or somewhere else?
No, he's somewhere else.
No, so his pay stub would look a little different, but you could see who's holding the higher, a higher percentage, and start there. And then if you reduce your dependent by 1, and maybe just do it for one of you, and see how that impacts the pay stub. Take a look at your next pay stub after you've reduced that number of dependents, and see how that impacts your federal withholding.
Okay,
Does that make
perfect. Thank you.
sense?
Yes, thank you so much.
Do you have a CPA doing your taxes, or do you do it on your own?
Yeah, I have a CPA.
Yeah. So if you do have a CPA, I mean, especially this time of the year, when you get your tax return back, ask them about this. I mean, we're trying to give you as much information as possible, so you can do it, or at least be informed. So, but again, this is a really good one to run by the CPA.
Okay, perfect. I'll ask her.
Perfect.
Thank you.
Yeah, you're welcome.
All right, let's move on. We'll stop again in the end for questions. All right, so we're going to jump into Medicare premiums. So it sounds like most of you are still working, so likely not on Medicare. But when you do get on Medicare and you're paying the different parts throughout the year, you need to be aware that there's something called IRMA, or a Medicare premium, that surcharge that you pay every month. And you can see in this table that we're showing you the 2025 premiums, and it's based on your income level, and it's essentially your gross income. You can see individual, joint income levels, and it's per person. It's very important to know that this is not a per household premium. And so if both spouses are on Medicare, and their incomes are, combined in between these two, you're going to get hit twice with that number. Now, the reason why I'm showing you this is that it's very common to be in a situation that you're paying too much premium surcharge on your Medicare. So the reason for that is it's based on the last 2 years tax return. So this is 2025 numbers, and it says 2023 filed tax return. Why is that? It's usually the most recently filed, completed tax return that's in the system. And so if you were to retire, let's say at the end of this year, you would need to likely appeal this surcharge. And there's a form that we help clients fill out. You just mail it in. And on that form, there is something called a life-changing event that gives you a reason to appeal this number. And it's under work stoppage. Now, it's common that they're not going to send you a letter and saying you need to appeal it. So you need to be on top of this, and because they don't know where your income is today. They just know where you were 2 years ago. So it's important to do this. We've done it with clients, saved them thousands of dollars per year, just because they just didn't know. And they just went ahead and paid that premium. And again, the form that you want to look for is listed on the upper right, or just Google Medicare premium appeal form.
And I also dropped the link in there too, just so you
Oh,
can
great.
see what it
Thanks,
looks
Tom.
like. It's just on the SSA.gov site.
And any questions, you can get to that in a second, put it in the chat. But I'm going to move on just because of time sake.
I asked,
Go ahead.
can you go back one? Okay, stay there. So
Yes.
I'm an individual and I'm
Yes.
still thinking, and I thought about doing Part B instead of taking Wells Fargo's medical plan.
Right.
So I would just look at the income. So for instance, the second income on individual. So Part B then by myself, is it the 185 or the 259?
Well, I'm sorry, I didn't mean to underline that. I thought you were referring to the second line of, so whatever your income level, you file individual tax return?
Yes. Because my husband's passed.
Got it. Okay. So whatever your essentially gross income, or AGI, it's referred to as MAGI, is, wherever you are in this table refers to what the Part B premium would be per month.
So if I was the 106 there, I would be 259.
That's correct.
Okay.
Yeah.
I just want to make sure.
Yeah. And now remember, if you were in a higher income level 2 years ago, they're going to put you in it based on 2023's income level.
Okay.
So keep in mind that death of your spouse is also, I don't know when he passed, is also a life-changing event.
Okay.
Okay. Any other questions? All right. Okay, so now no, it's not coming up. Here we go.
Yeah.
Hey,
So
Todd?
yeah. So we find a lot of Wells Fargo employees are very charitably inclined. But what we also see is that, your charitable donations saving you taxes. And a lot of people, and this isn't the primary reason that we see people giving, but it's also, we want you to be informed. So most of your charitable donations are probably not saving you taxes. And that might come as a surprise to, to some of you, because you think, oh, give something to charity and I get a deduction. Well, there's something called the standard deduction, and a number of years ago that went up to $30,000. And in your standard deduction is that's 30,000 completely off of your income. Okay, or you can itemize, and that's where charitable donations come in. So if your charitable donations plus your other itemized deductions are not above 30,000, then you're not getting any extra deduction for that. You're simply taking the $30,000 standard deduction that everybody gets. So what is if you're very charitably inclined and you're like, okay, well, I'm going to continue giving this for a number of years, how can I have this work in my favor as well for taxes? Well, there's something called a donor advised fund, and this is a possible solution for long-term people that want to donate money over a long period of time to charity. Donor advised fund, it's really inexpensive to set up. People think, it's for like the uber wealthy, and it's, anyone can really set these up through their brokerage account. Schwab has them, Fidelity, a lot of other brokerage companies have them. So in this example, and I think you want to click to the next, I think there's an example under there, Britton.
Yes.
Yeah. Yeah. So let's just say in this case, you were giving typically $10,000 per year to charity. Now, with the $30,000 reduction, you're not going to get anything. You're not going to get any extra. But let's say you knew you were going to do this for the next 5 years. So you knew you were going to commit to $50,000 for the next 5 years. So what you could do is you could take that money. Now, again, this is where a taxable brokerage account comes into play. So if you have that set up, you could pull from that, take that money and put it into a donor advised fund. So 50,000 pre-fund the 5 years worth of donations in this donor advised funds. So you put the 50,000 in. Now all of a sudden your itemized deductions or donations are above the 30,000. So you've just gained yourself $20,000 in additional tax deductions for this year. Now, then the key with this donor advised fund is people say, well, I don't want to give 50,000 here all at once. Well, you don't have to. You get the deduction this year, but you can give to charity over the next 5 years, 10 years, however long you want. But you get the deduction this year. So if you're getting an extra, say, $20,000 in savings this year, and you're in the 20% average bracket, then that's $4,000 of extra tax savings. So it could really have a big impact. You have to have that money to, commit up front to do this over a period of time, but it's just a little bit more of an advanced tax strategy, but, very doable. A lot of our clients do this. And you can also donate appreciated stock into the donor advised fund as well, which is another tax benefit to you as well. Any questions on that? Has anyone ever used a donor advised fund before?
You can use smaller amounts. It's really a way to streamline multiple donations. If you do give amounts to multiple charities online, it can cut time by having to mail checks. All right. I want to go into, we're almost wrapping up here. On the last slides, it talks about tax loss harvesting. So when and why would you do this? And with the taxable or the brokerage account bucket, that third tax bucket that we talked about in the beginning, you may have some gains or unrealized losses at certain times. And why would you sell some of the losses? And the reason is that you would be able to bank losses to offset current or future capital gains, or even up to $3,000 in taxable income per year. And it's common, and the way it works is you sell the position, and then you buy a very similar position, not the same one, because that'll negate the tax loss. A very similar position, or very similar security to remain invested in the market. And that way you have harvested that loss and you're still invested going forward. Times to do that, like when it's, when markets are going down, 2022 was a very common time for us to do that for clients. It's also a very emotional thing to do, is to make these trades and come to the point where you're saying it's time to sell this loss and then buy something else. Most people don't have that ability to face that and do that. So having an advisor or somebody to help you that is important. we don't have any emotional tie to our clients' money, so we can look at these strategies very objectively. I'm going to come on to the last page and then we'll open it back up. So the real premise of this page and the whole the theme of the show here is to coordinate with a financial professional, and you have a lot of decisions that impact you financially, and we simplified in these 4 areas. This is the premise of our financial planning approach. You've got cash flow management, investment positioning, tax planning, and estate preservation. Really, any decision that impacts you financially will fit somewhere in there. And you may have a CPA that you work with, maybe an advisor. It's important to have coordination, and somebody who's like with the backdoor Roth or communicating with your CPA, making sure it's filed properly. It's very common it's not. And it's common to have financial professionals working in their silos and not communicating. So having that coordination is key. All right, well, let's bring it in for a landing. If you have any questions, final questions, you can put them in the chat, raise your hand, take yourself off of mute. Todd's going to provide you with a link to the calendar for 2025, the financial calendar we've put together. And also, I'm going to let him speak just a little bit about the new education series that we launched.
Yeah, so I did there's a few links in there in the chat. The first one is to the 2025 financial calendar. Next one is just a link to our site. If you have more questions or want to chat with us one-on-one, we happy to do that. No obligation, no pressure, just have a conversation. And then the third one I put in there is, if you like some of the things we talked about today and you really want to educate yourself more about some of these tax strategies and about, whether or not you're on track for retirement, we put together Wells Fargo Retirement Blueprint. So it's a free email course that's going to teach you more about defining your retirement number, how your retirement accounts, investments are taxed, how to what order withdraw your money from in those accounts, and some advanced tax strategies, along with a few other things in there. So if you do have an interest in kind of learning more, educating yourself, we've gotten a lot of great feedback on it. We just rolled that out a couple of weeks ago. So that link is in the chat as well. Okay, I think that wraps it up, Britton. Thank you all for the questions. That always helps. Really, really good questions, and appreciate that interaction. So have a good weekend.
Have a great weekend. We'll be doing this in the next quarter.
Thanks for your time.
Absolutely.
You're welcome.